Well, for more analysis on what drove really the local market and global markets around the region and the world, of course, global, in 2017, Jack Lowenstein is the co-chief investment officer at Morphic Asset Management, and he joins me live in the studio. Jack, good to see you.
Good to be here.
Thank
I feel my shirt is a bit too formal.
It's way too formal. I should have specified Hawaiian shirts only today on this first day back of trading. Thank you for coming in on this shorter week. Let's talk about sort of global markets. How did we fare? We seem to sort of stumble along in that trading range for a long time, but how did other markets, both around the world and in our region specifically, do?
Well, Australian investors did better in global markets than in Australia, but they did well in both, to be quite clear. They did about 12.5% in global markets and about 7% domestically. What I thought was really impressive, though, was that that really good performance overseas was despite something none of us really expected, which was the rising Australian dollar, which was up about 4 US cents over the year.
So why did it do that when nobody was really expecting it?
What, the Australian dollar?
Yeah.
I think it was partly the strength of commodity prices.
Yeah.
Both coal and oil so coal and iron ore had good years this year.
Yeah, and also I guess the greenback wasn't as strong as people had thought with the American recovery.
That's right, and I think that was probably the unwind of some of the Trump enthusiasm, if you like, that we saw this time last year. We were still talking about the Trump bump. Remember that, which was the unexpected rise.
Well, he's still taking credit for it.
Of course.
Yeah. So what did happen with US markets? Because, of course, the NASDAQ was very strong, but were the other indices there?
Well, NASDAQ had a really good year. It was up about 17%, whereas the US market as a whole was up about 10%. Now, an important point is that the energy stocks did really badly. They were about 10% down. And that was because people were too optimistic about the oil price at the beginning of the year.
Okay, now some of the other markets that you have followed over the years that we've been talking. For a long while you had a bit of a love affair with India. Now India's got, its problems for sure, and Prime Minister Modi certainly started on a path to change the way things were done, to be much more pro-business. Are you still as in favour of India? Is it still returning?
Look, the Indian economy is not exactly booming. It's growing about 6.5% a year, which by Indian standards is pretty slow. The Indian stock market has done very well. It was up about 27% last year. And I guess that took us by surprise a bit. We had cut our positions there, not completely, but substantially, because there have been all these really difficult things that have happened, like the demonetization of the currency, the introduction of a new sales tax, a national sales tax.
The GST, virtually.
And those things were definitely expected to slow the economy. They did. But the market saw through them more than we expected, so that's why the market did so well.
So in terms of the reforms that he promised, the sort of progression that he was really promising business, did he follow through with that?
I think he did. I think a lot of the stuff he's done is very brave. It's stuff that's going to take more than one election period or election cycle to get rewards for, so you've got to give him credit for that. Of course, this time next year we'll be talking about the upcoming Indian elections, because it'll be 5 years since the last one, and we'll see how he goes next time round, but I think he'll get re-elected.
All right, so how will the stock market do? If it did so well, 27%, is it still on that massive upward trajectory?
I feel that it's probably done its best. It's interesting, India did really well in the first half of last year and less well in the second half of last year. Or I say last year, I mean this year.
2017, yeah.
I feel like it's already over.
Yes.
I just don't think 2018 is going to be that great a year for India.
Okay, now you also started 2017, we had a couple of conversations about you were shorting Wells Fargo Bank in the United States. Now, that bank has had a lot of trouble. How did you go with that?
It didn't do as well as we thought it would in an absolute sense. All the scandals kept on rolling in, but in the end, the tax cuts, the Trump tax cuts, have meant that domestically focused banks have seen the prospect for their earnings to go up quite sharply. The good news, though, is that we used the money we gained from shorting Wells Fargo to invest in a collection of smaller domestically focused banks like Bank of Internet, Bank of the Ozarks.
Bank of Internet?
Yes, Bank
of Internet. It's one that's passed me by.
It's a thing.
What, it's all online?
It's all online or using call centres.
Which, of course, I mean, a lot of banks are heading that way anyway. They want to move us out of branches and very much online.
Well, they have no branches. So,
yeah, so this particular bank, I mean, I'm sounding surprised, but in fact that's very much a trend for even the big bricks and mortar banks
it
too.
is, but these guys have the advantage they don't have to get rid of their branches.
Yeah.
So it's one of our picks for the year ahead. In fact, we think that it's on about 10 times PE, which is cheap by US bank standards, mainly because many people are very sceptical about the business model. But there's been a huge short covering rally in the last couple of weeks, and we expect that to continue.
And where is that based?
That's based in San Diego.
Okay.
A place I've now been to twice.
So California based, to have a look at it?
Yes, to have a look at the people. At least there's not much to look at for those.
Yeah, no, exactly. All right, now Japan, we've also talked about a lot this year. Let's talk about the stock market first and the sorts of sectors that you invested in. Do you still like them, and was there value there for you?
There definitely was value. I guess that Japan's a market that didn't do quite as well as expected as a whole, about 12% for the year. But we did very well there because we were very focused on a narrow set of sectors, particularly in the housing and construction sectors, which has done very well. One of our stocks, Open House, doubled over the course of the year, which is nice for a mid-cap. It's not a super small cap.
Yeah. Now, Open House was what sort of a... was it a real estate agency?
They have a real estate agency, but primarily they build small family homes in the centre of Tokyo.
Right.
So they're a real estate developer.
Now, if we look at the economy of Japan, are you still thinking that it's good? I mean, Shinzo Abe promised a lot, Abenomics. There has been a lot of commentary that he hasn't delivered on everything. I mean, there's been very strong monetary policy push, but there's still kind of tepid spending, isn't there? It's
very hard to deliver on everything, but I think he's delivering on a lot. The fact is, while we were having Christmas, they announced inflation had hit nearly 1%, which is a bit of an encouraging sign in terms of getting rid of the ghosts of deflation. The economic growth, I think they're having their longest sequence of economic growth for several decades. So although growth is rapid, it is steady. And the stock market, of course, is its highest level in nearly 20 years, or more than 20 years. So that's a good thing.
Yeah, okay. So should Australians and Australian investors, be engaged in places like US tech stocks, which are just constantly talked about seemingly, the FANG stocks, and is it too toppy, is it too boomy?
I got a feeling it is getting a bit toppy in some of those FANG stocks. I think the problem with people like Facebook and Google is they're great businesses, but they are actually kind of monopolies. And the trouble with monopolies is governments don't like them. At some point, there's a real risk that Facebook or Google will be forcibly re-regulated or forced to break up. Okay, very brief preview for next year. Where are you looking at a new market? No, I think that we have a few new stocks, but not. So we're actually very excited about the environmentally focused stocks in China, which is the first you've heard from me probably. So we own China Everbright International, which literally takes rubbish and turns it into gold. They burn household waste to make electricity. They get paid by governments to take the rubbish away. And we're also we think that it's going to be the year that Bitcoin implodes. For what it's worth. Yeah, well, I think, you're a sensible head, and do you think too many, perhaps younger generation are thinking that this is just going to be fantastic, I've got to be in on it? Well, there's an old saying, when the taxi driver starts asking you about Bitcoin, there's probably a problem, or, about anything, it's probably near the end. So no offence to taxi drivers, of course, but it just means everybody's piling in late. It means, exactly, it's the late guys usually get burned. All right, Jack Lowenstein, Co-Chief Investment Officer at Morphic Asset Management. Great to talk to you. Thanks for joining us. Happy New Year. Happy New Year. See you in 2018. Perhaps in a more colourful shirt. Yes, you can wear a Hawaiian shirt if you like. Thanks very much, Jack.